Hey, good morning, everyone. Marty Mazzori here. It's March 14th, 2024, Thursday, with your end-of-week market snapshot. Clients will get this attached to an email as Friday's message tomorrow. Folks, I'm going to keep this one pretty quick. My schedule here at the end of the week demands that I do that. But I think the overall message of this video is very important. I even said in the morning note, which I'm going to paraphrase here in a second, that this is a must-read post for, at least for our clients. And so I'll just jump right into it. I will get into the technicals a little bit, but I really want to focus on the valuation setup and as well, maybe on a shorter term basis, the sentiment setup that we're dealing with here at the moment. So again, the title of this morning's post was Patience an Absolute Must. And I start with a quote from one of my favorite analysts, Randy Finney. If patience is a virtue in life, it is an absolute must in trading and investing. If you tend to think of stocks and your long-term portfolio synonymously, well, if you're all in stocks, then you should. If you're one of our clients, I'd say don't do that. But recognizing that Wall Street has done a masterful job of ingraining such thinking into folks, the following is intended for those who actually do find the two synonymous. So updating a few charts, I just basically wanted to look at basic valuation metrics. So here's the 30-year chart of the price-to-earnings ratio for the S&P 500. That's here in the top panel. Actual price is the bottom panel. And I highlighted where we were above 23 on the PE and then where it kind of bottomed, as it came off of those levels. And so you can see here that we were way up there prior to the tech bubble. We didn't even get close, interestingly, before the real estate bubble burst. And then 2018, and then right after COVID, as they dumped in all that stimulus, prices went to the moon at a high price-to-earnings ratio. And then currently, we're pretty comfortably above 23. And those areas, when they corrected, turned out to be 50%, 20%, 27% declines respectively. Of course, question mark where we are or how that's going to play out today. And it was a nearly 60% decline, just really from valuations that weren't over their skis because we had other economic issues there in 2008. And then price to sales ratio, which I respect more because it's tough to manipulate revenue. It's somewhat easy and common practice to manipulate earnings. And so I like the price to sales probably more so than the price to earnings. Price to sales is above 2, and you can see it's rare. Tech bubble, going into COVID, and currently. And then I just recited what those declines were respectively. And then price to book is historically high, and it didn't even get that high pre-COVID, as high as it did during the tech bubble before a 50% decline. So you can see where we are for the S&P. Nobel Prize winner Robert Shiller invented the cyclically adjusted price-to-earnings ratio, a highly respected metric among good, thoughtful analysts at 34.54. Currently, Jeremy Grantham talks about the history of CAPE PEs that high. There has never been a sustained rally starting from where we are right now. The only bull markets that continued up from levels like this were the 18 months in Japan, the last 18 months until 1989. And by the way, just like a month ago, the Japanese main index finally got above that 1989 level, believe it or not. And U.S. tech bubble, 98 and 99, we know how those ended separately. We've never had a sustained rally from full employment, which you could argue is where we are right now. Simple rule, can't get blood out of a stone. If you double the price of an asset, you typically have its returns. Cut that in half. So essentially, folks, these parabolic moves, in essence, pull forward when valuations go crazy, and you can talk about specific tech stocks, for example, essentially virtually have to be pulling forward potentially years of return. I'm going to give you some striking statistics here in a second. And then the Buffett indicator, which is market value to GDP, 184%. Okay, so we're just right where we were when we had that kind of freaky anomaly with all these stimulus around COVID, so we're way out over our skis from a valuation perspective. And as I keep mentioning, we're there from a sentiment standpoint as well. And in the written blog, I feature the advisor bull-bear spread, 46.4. We're even now above the range, which they say is the danger range, and the range where taking defensive measures is important. And they do say, and I repeat below here, that tops usually form over weeks and sometimes months. And so you can see that. Here's months and months where we just kind of danced around a super high level before the market fell apart in 2022. And we're back at those levels again. And as I like to point out, we're back there big time on individual investor sentiment. And again, you've seen this chart dozens of times here, but just to point out, here's where we were prior to that 27% decline. Here's where we are now. And then it was the opposite of that, negative sentiment before the rally in 2023. But even during 2023, here's where we were before that double-digit decline from July to October. See, and then again, that got set up, and I was bullish here short term, and I was showing you things like these then. So just looks like a really precarious setup. Frankly, folks, short term and further out, based on valuations. Short term based on the sentiment, perhaps further out a ways based on valuations. Although valuations are really terrible timing tools. The market can stay irrational or overvalued longer than those who want to short it can stay solvent. A phrase by the great John Maynard Keynes 100 or so years ago. And then I quoted Peter Bookvar in the blog post as well. Let me go back to that and share with you that quote. A parabolic price move is a parabolic price move, whether with one stock or many. He doesn't care when it has taken place. It is a vertical move in a stock that always ends the same way, about back to where the move started, and he don't care what the stock symbol is, what medical disease they are solving, and what greatest technology ever product they have. This was a comment he made yesterday, and I just copied and pasted it here. So, he makes the point that everybody's kind of comparing the current environment to the late 90s. You've seen me do that here. And he also sees many parallels to the 2021 situation right before we had the 2022, I think, beginning of the current bear market, if I may. And he doesn't bother with the comparison at this point because he feels what I just quoted from right here, that it's a parabolic move and it's going to end in pain. And as we all did a few weeks ago, I did it too. I didn't realize everybody else was doing it, but to me, it was an obvious comparison between NVIDIA and Cisco in the late 90s. You may recall that analysis that I shared with you. And what I said a minute ago, it pulls forward many years of future returns in a condensed period of time. And this is the shocking statistic I was talking about. Cisco had adjusted earnings per share in its fully 2000 fiscal year of 0.57. For its fiscal year 2024, the earnings estimate is expected to be $3.72. That's a 550% increase in earnings per share. And you know what the stock has done during that time? It still sits 38% below its peak in the year 2000, I believe, late 90s, 2000. I believe it was during 2000. So that is striking. Literally, we are sitting here 20 plus years later, and the stock is still 40% below that high, even though earnings went through the roof. So we pulled forward 20 plus years of returns in Cisco stock. So folks, we need to take that very seriously with the phenomenon that we're experiencing right now. Now, there is pushback, and I not necessarily disagree with it. Cisco was then 140 times earnings, 31 times sales, while NVIDIA's PE looks much more rational at 36 times. And it's high, but it's more rational, of course, than 140. But in a very cyclical business, assuming a 77% margin sustains itself for 5 years plus, and that's what's being priced in, when its largest customers are looking to be their competitors. Yes, they're developing their own AI chips. Such an assumption is heroic. Pricing relative to sales is a better perspective, he believes, and is currently 20 times, and assuming an average of 20% revenue growth over the next 5 years, by 2028, it'll be trading at 10 times sales. That said, the purpose of these comments is not to value NVIDIA at all, and we own some for clients, and that'll of course be tucked into our tech ETF as well. What he's just pointing out is the pull forward of future returns of massive parabolic stock moves are taking place, as also seen in Supermicro and even Abercrombie and Fitch, Vistra, blah, 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 and even GE is looking like it. As the legend Bob Farrell once said, parabolic advances usually carry further than you think, but they do not correct by going sideways. So folks, some history there, if you will, that we don't take lightly. And please keep in mind, yours truly lived through all of that while navigating and risk managing client money. Anyway, for what that's worth, and let's just close with just a quick look at some charts. S&P 500 daily chart. I call this a rising wedge pattern. I call this a bearish divergence. This is a sell signal. It wouldn't be a sell signal based on how we look at things until it breaks down below the uptrend line. It's been flirting with that. Not a good looking setup right here, folks, technically speaking, at least on the daily chart. NASDAQ 100, or the ETF that tracks it, has broken below its uptrend line in a rising wedge pattern with a bearish divergence and a sell signal on the MACD. That 20-day moving average has saved it time and time again over the last multiple days. We'll see if that continues to happen. Very well could. Not necessarily making a call there. Looking at yields with today's hotter than expected PPI. Yields are rightfully so popping today. That's bearish for stocks, although it was interesting because when the PPI first came out, stocks stayed in the green, and I started pondering, the fact that, that makes some sense, because if the economy is going to be okay, and that's not our base case, by the way, but if it is, then, rising prices, as long as companies have pricing power and they can rise them with or faster than the pace of inflation, well, then that's going to be bullish for earnings. And I think that might have been the initial knee-jerk narrative, if you will. Maybe, who knows? But then stocks rolled over. They're still a little bit in the red. They were more in the red earlier. The S&P is down about 0.25% as I speak. And then such a PPI number should be bullish for the dollar as well, and which it was. You can see this spike here on the dollar. Not much to talk about here. You could say that we've got a bear flag pattern developing here. If that's the case, then we're going to get some different kind of economic news, which I think we're ultimately going to get before this cycle plays itself out completely, and that would be lower dollar, at least initially, as the economy wanes and interest rates come down. Then if we have a recession, then typically flight to the dollar and treasuries, and then you get a rebound. But again, those things are yet to happen, but things that we're thinking about and looking for the signs of as we go forward. So folks, I'm going to stop there. Appreciate you. Thank you as always for watching and listening. Next up will be the weekly economic update. Take care. Bye-bye.